morning, everybody. Welcome to Coffee with KPP Live, the show that's dedicated to providing you with advice for life so that you can live richly and work towards the life that you've earned. My name's Kyle Roy. I'm a financial advisor with KPP, joined with my associate Ben Hopper. And today we're going to have a pretty heady conversation about the markets, the current state of affairs. We're in August of 2021. We're almost 18 months into the coronavirus COVID pandemic. And really, we were talking in preparation for this show, we really feel it's been a great educational experience on basic concepts of investing. It's really been a microcosm of understanding human behavior, human emotion, how it incorporates with investing. But what we're going to do today is really kind of peel back the onion and give our audience some insight into how Ben and I and our team at KPP, when we're trying to figure out where the puck is going, so to speak, some of the conversations that we're having, and what we really came to the conclusion is that the markets are a relatively logical creature. When we look at what's gone on in the last 18 months, we're going to be able to glean out for you some very basic and advanced investing concepts that might be able to help you in your portfolio.
That's right, Kyle. I'm excited to be on the show, and hopefully with that introduction, we didn't scare you away just yet. But we're excited to talk about these topics, and really we found that it can be challenging. This isn't easy stuff. This isn't things that are often the simplest creatures, but we believe that with some of this data that we can provide, that we can look back on, it's helpful whenever you study it.
That's right, and just so you know, here's the disclosure. Being fully licensed firm, securities licensed with the SEC and FINRA, we do need to make it clear that we aren't making any specific investment recommendations. Always consult with your financial advisor. If you don't have a financial advisor, feel free to give us a call at Kentucky Planning Partners if you have questions or would like some help with your personal finances. But investing involves risk, and everything we discuss here is going to be very general. We're not making investment recommendations at all, but we're really just going to walk through some of the discussion points and views that we have about where the markets have been, what we've learned, and potentially where we might be overweight or overvalued in our portfolio planning. So there are really 4 different types of asset classes we're going to walk through today, and we can glean a lot of information about based on the way that they have behaved since the pandemic started. So first we're going to talk about the bond market. We can learn a lot about investing by the way the bond market and treasury markets have behaved since March of last year. We're going to look at large cap investing. So large cap investing is what you'd think about with the S&P 500 or the Dow Jones. When we look at Europe and we look at developed markets, the FTSE, the CAC in Paris, the DAX in Germany, these are large cap markets where you have established companies in developed countries that they're trading on those markets. We're also going to look at small company stocks, generally represented by the Russell 2000 is the index that tracks small companies and those companies that you expect to be the large companies in 10 or 20 years, and then developed markets. So the first thing we're going to look at are bonds. Last March, when COVID became a reality, right? There were whispers of it in January and February, but in March it became a reality. People were scared. And when people are scared, Ben, what do people want to do with their money?
Protection. They want protection. They want quality investments, if any investments at all. We saw a lot of investors that got so scared that they went overweight into cash. And as we saw with the quick recovery last year, some of those investors might have regretted their decision. But cash, safety, protection, that's what people are looking for when we see something like a 35% drop in the market in a 4-week period, if that.
That's right. So. And when that happened in March, we saw bond yields, or the rates that you earn. The yield is the return you get on a bond while you're investing. What did we see with bond yields?
Sharp decline.
That's right. And the reason is because when people want safety, they plow their money into what they believe to be our safe investments. So the 10-year treasury is effectively government debt that if you lend your money to the government, they're going to pay you a rate, and then after 10 years, the government will give you your money back plus that last payment, right? 10-year treasury yields fell to the lowest point they've ever been. March of last year, they fell to 0.51% in March of last year. And that was off of what was historically already a very low point. I think prior to March, they were around 1.8 or 2%, very, very low. Fell to 0.51.
And we saw negative interest rates in other parts of the world. That was even crazier. And we had those conversations of, can the U.S. get to a negative interest rate environment? And we didn't last year, and we don't think we will, but this low point in interest rates has been a big topic recently.
That's right. And why do interest rates go down when people are scared? And it's because the bond markets, what most people don't realize is the bond markets, just like the stock market, is dictated by supply and demand. Mm-hmm. If there's a high need or high degree of safety that's demanded by average investors, people will plow money into bonds. And whether you're the federal government or a company and you're issuing debt, you want to issue that debt at the lowest interest rate possible, right? If I'm making a large purchase, I'm a lot more attracted to 0% financing than I am to 5% annual interest, right? Well, if the government is issuing debt or a company, they want the lowest rate possible because they're able to get that capital at a very low cost to them. So if there's high demand for safety, bond issuers don't have to entice those investors with high interest rates to get them to have their money lent to them. So we saw interest rates fall, and what's important to note, as interest rates fall, the price of bonds go up. So price is an inverse amount to bond yield. Yields go down, price goes up, bonds are more valuable as yields go down. So we saw the bond market really go skyrocketed in March of last year, as you'd expect when there's a high demand for safety. But then in March, we saw stimulus come out. We saw a clear plan forward with COVID-19 that was very well received, not only by the general public, but by the marketplace. And what did we see with the market?
It goes up.
It went up.
To the right.
And what's the acronym that you had?
TINA. So the environment we've been in with interest rates, with bonds being in such a challenging environment with low yields, if we potentially see a rising interest rate environment because we are still so low, then like you just said, that inverse relationship, bond values will go down when yields go up. So what the TINA means is there is no alternative. TINA, T-I-N-A, and what that is an acronym that we've used to just in conversation with equity ownership. Mm-hmm. Whenever bonds are very hard to own because of the future predictions, the future potential of what we might see there's no alternative to owning equities in a lot of ways. So
yeah, and just to be clear, we're not saying there's no other alternative to bonds.
Sure.
We have been able to build really high quality, short duration bond portfolios, tax efficient bond portfolio. But TINA, that there is no other alternative, is really a great way to explain the tremendous run that we saw in equities. The market was flush with cash from stimulus relief. People were plowing money into equities because if you can't earn money in safe investments, well, the general market, or you'll hear analysts say there was no other alternative. We saw the market flush with cash. Now let's go to that second sector that we saw, though. We saw large cap, and we saw actually last year, let's face it, there's the old saying, when the tide comes in, all boats rise. Last year, all markets really went up, generally. I don't know of any equity markets that didn't
Sure.
do well last year. So whether it was developing markets, developed market, it didn't matter.
And if you look at that in March and said after we saw the COVID start and the 30% decline, everyone would say you're crazy if you think everything's going to be up. If you think anything's going to be up by year end, you're crazy. And yet we saw it. So that's just how crazy markets can be sometimes. times.
That's right. I mean, the S&P was up 30%, close to 30% last year.
That's
I
right.
mean, the NASDAQ absolutely blew it out of the park. Even today, it's August 3rd, and we're really seeing the Dow hit all new records, potentially.
Yeah.
So now here's the interesting thing, though, okay? So we almost saw a brick wall hit in February, okay? In February, we saw the market peak, or most markets peak. In February of this year, of 2021, we saw 10-year treasuries hit 1.74%. So remember March of last year, what was the low point? Do you remember?
0.51.
0.51% was the low point in March. In February of last year, less than 12 months later, we saw more than 3x return on the yield of treasuries. And remember, when yields rise, what happens to bond prices?
They decline.
They decline, right? But in February of this year, we saw interest rates peak at 1.74. Today, on August 3rd, we're sitting at a 1.1% 10-year treasury rate. We've seen demand for safety come back into the marketplace. We've seen the markets calm relative to where they were last year. We've seen volatility ebb. But this is a really important part of the show because since the beginning of the year, what has happened in the large cap sectors?
They've continued to rise.
Pretty consistently, right?
Consistently, steadily. But we wake up and the S&P 500, representing 500 of the largest companies in the U.S., is up about 18%, give or take. So
year to date, 2021, as of this morning.
And so a lot of people might not realize that because it has been steady. It hasn't been sharp like last year. We saw sharp declines, sharp upswings. This year, it's just been ticking along. So.
But that's the same if we look at the Dow Jones Industrial Average, if we look at the DAX in Germany, if we look at the FTSE in England, and we look at the CAC in Paris. So these developed economies and the strongest and largest companies in these economies, we've seen tick up and to the right relatively consistently. So what that tells us is, in a time of uncertainty, with interest rates low, people are going to invest in those companies that they feel are going to be around for a long time. And we've seen that make sense, right?
Makes sense, doesn't it?
So now what's happened, though, and this is really why I wanted to talk about this show, what I think is fascinating. Now if we slide over to small companies, so the Russell 2000, again, is an index that's made up of 2,000 small cap companies. So the companies that you think are going to be large in 10, 20 years, invest early. That's what you do with the Russell. And generally, historically, past performance is no indication of future results. But historically, if you wait long enough, the Russell 2000 should outperform the S&P, right?
Small cap and mid cap tends to outperform large cap over the long run. Historically, that's what we've seen when you go back a very long time. And that's because those growth companies, those small companies, can return more. If you think of something like Apple, is Apple very likely to have a double digit or a doubling of their market cap? Probably not, because they're already so big, right?
But if you gone to Apple in 1989,
different story. Right.
That's right.
And Apple used to be at one point in time, they were a small cap company. So investing in small cap companies that have high growth potential tends to do better in the long run than your largest companies out there. But that's not what we've seen over the last 5 years, 10 years. Many investors might forget that because of the outperformance we've seen in the large cap space.
And especially as of late. So year to date, we wrote the numbers down. Year to date, from January 1, 2021 to August 3rd, actually this morning, before we began filming the show, the Russell 2000's up 14% year to date.
But that doesn't tell the whole story.
No, this is the fascinating part. Since February 9th, the Russell 2000 is at a 3.5% loss. So that means the index is up 14% year to date. But if you take out January from that equation, small cap stocks, specifically the Russell 2000, down 3.5% over that period of time. So we saw in February two things happen. We saw 10-year treasuries spike at 1.75, and they've come down to 1.1. And we've seen small cap stocks actually decline in value since that point, while large cap companies have steadily rose over that period of time, okay? Which is actually really fascinating to me. So what it tells us is that the large cap companies seem to be climbing this wall of worry, getting back to your acronym.
TINA.
TINA. There is no other alternative potentially, or there hasn't been. Again, we don't necessarily believe that, but that's what the general market seemed to suggest. The other, in that fourth market we talked about, are emerging markets. Emerging markets, you would think logically, during a pandemic, emerging markets countries haven't had a vaccine accessible to its population, as well as America or developed economies in Europe. So you would imagine that they're going to have a harder time during the most trying times of the pandemic. The companies aren't going to be able to get a footing if their employees don't have the means to get to work. If it's an emerging markets economy, infrastructure probably isn't there, whether it's public transportation to basic internet services. So people aren't able to work from home and do Facebook Lives like we are, podcasts like we are, connect with our clients like we can. So when we look at the two sectors, equity sectors, that have really struggled this year, emerging markets and small companies, it makes sense because there's still fear, especially since we've had the Delta variant come out, that people are going to or invest in places that they're more likely, they feel, to get the return. And those large behemoth companies and those developed economies, in people's opinion, are going to be the place, and it has been so far this year, where they're going to get return, whereas small companies that don't have the balance sheets that you may like, that are going to be less likely to make it through a pandemic if shutdowns occur, and develop economies where people can't get to work, it's just a lot more uncertain.
Yeah. And when we look at the international space specifically, so that emerging markets topic and the developed markets topic, traditionally with a balanced portfolio, investing 101 might say that you should have about a quarter, maybe 20% in these spaces. What we've seen with our clients and with our portfolios is that because of this outperformance and because of these question marks in the international space and how strong the U.S. has been, it's been we've seen underweights to these sectors. We've seen a lot of portfolios that might only have 10% or 5% or 15%. And so given this underperformance, with emerging markets being about flat year to date, down 10% since February, it might be a good time to do something like rebalance and maybe increase exposure. We're not making any specific recommendations. It's all dependent on your personal plan, and there's a lot more factors that go into it than just saying you should go invest in emerging markets. We're not saying that, but generally speaking, the theory says that it might be a good time to shift some dollars into that direction. And the other thing with emerging markets to take into consideration is that, in theory, if the value of the dollar does decline, we don't know if it will, but if we have inflation, if the U.S. and the value of the dollar is under a lot of pressure, in theory, that's a favorable time for emerging markets economies, whether it's EM equities or emerging markets debt, maybe bonds. So that's something to take into consideration too. If you think we're going to be under increased pressure from inflation and the value of the dollar takes a decline, that tends to be a good time for emerging markets. So something else to consider.
Yeah, and what you just described is really the hardest part of investing, because we all know the adage, buy low and sell high. And everybody out there, when you're trying to pick investments for your 401k or your do-it-yourselfer, what does everybody look at?
Past performance.
Past performance, right? And so, and if you're an amateur investor and you don't know the difference between large cap or small cap stocks, and you're looking at an international portfolio and you don't know the difference between an emerging markets and a developed markets fund, well, generally, most people just pick a few investments that have done the best, right? And in investing, the irony is it's kind of like driving with just focused on your rear view mirror. If you drive just focused on your mirrors, ultimately you're going to hit something. And I love the analogy Rob, our CEO, uses. He said there's a reason why the windshield is a lot bigger than the rear view mirror, right? You want to be focused on where you're going. And in investing, it's really difficult because when we look forward, right? Again, we have no idea. Nobody can predict the future, but hopefully you can see what we've tried to break down is the logic in the market, right? When people are scared, they go to bonds. That's why interest rates went down, because demand for safety was there. When demand for safety ebbed because government stimulus came in, people felt safer with an income, they went back into the markets. Interest rates went back up because companies and governments need to entice investors back. So interest rates went up. There's logic to the market. Why have small cap and emerging markets economies, emerging market investments struggled? Because they're not as safe when you look at a Delta variant, whereas these large companies will probably be around. But now if we look forward, right, if we try to peek into that crystal ball, right, now if you're building a portfolio in your 401k, why does it make sense to have small companies, small cap stocks? Because if we continue to see, ultimately, if you believe, and I think this is a very important question, and this is one we've been asking ourselves, do you think that we're closer to the end of the COVID crisis or closer to the beginning of the COVID crisis? Nobody knows. Nobody knows. But once COVID is behind us, right? And once we have vaccines throughout the world and we have herd immunity and people are comfortable to go back out, well, it's you can confidently, I think, say, and I just from a compliance standpoint, got to be very careful. But will those developing economies, the emerging markets, and will those small companies be able to thrive in an environment where people are out and about, having more fun, traveling more, seeing the world again, going on cruises, flying in airplanes, doing the things that this pent-up demand, because we're all at home the last 2 years, has done? So that's where, if we look back, short-term performance and some really great investment opportunities might not look so good, but that doesn't mean you should avoid them altogether. And in the short term, it's probably going to be a challenge because we don't know if we're closer to the end of the tunnel or just still in the beginning.
Yeah, and these are all questions that we ask ourselves too. You know, we're not up here. We always say we don't have the market cornered on great ideas. You know, we struggle with these things as well. But what we're here to do is to educate the average investor and the retail client to say, hey, why don't we take a step back? Why don't we slow down? Why don't we not listen to all the noise out there? It's noise. It's a lot of things that you see on the TV. It's a lot of things you see in the newspaper. Why don't we build out a financial plan and see, hey, how is your 401k invested? How is your IRA invested? How do we structure your balance sheet and your accounts and your investments to where long term you're most likely to reach your goals? That's what we're trying to do here. And oftentimes, most of the time, that's going to result in a balanced approach to investing, not one where we're going to high fly 100% in large cap technology, or we're going to do a 70-30 and 70% of it's going to be in cryptocurrency. You know, we're not going to structure something like that almost ever. And so that's the key, and that's where we can provide value to our clients, is in those conversations.
Absolutely, well said. And that's just it. I mean, we always want to keep our finger on the pulse, because in short-term experiences, there are going to be long-term opportunities. And we have to be able to understand what's going on globally and locally, so to speak, to be able to try to understand where the opportunities are. We want to be able to know where the puck is going, or try to best figure out where the puck is going, so that we can position ourselves today to be able to capitalize on that. And I'll tell you, one of the most difficult decisions that we make is when we make those rebalancing decisions. Instead of letting your bulls run, you take a bit off the top and buy those investments that haven't done so well. So I mean, I think if we just recap quickly what we said, again, based on these 4 asset classes or different investment sectors, so to speak: bonds, large cap stocks, small cap stocks, and emerging markets. Just based on the last 18 months and how these 4 asset classes have behaved, how they behave differently, I think it's a great education on how the markets work and how quickly they react to the news, and really how logical the markets really are, and it's so easy to get emotion caught up in your investment decisions, and your emotion will trump any logic that you might be able to incorporate into your investment decisions.
And that's where coaching comes into play, and psychology, because what we do is not just numbers based, it's not just percentage based, it's not just studying and looking at investment theories and that sort of thing. It's really being good at coaching emotion and psychological aspects, because that's what goes into investing and financial planning as well, just as much, if not more, than those other things that are more mathematical and more concrete. It's diving into the mind and coaching.
That's right.
And with investing, I always like to take it back to the story of the tortoise and the hare. There was a story that I heard once. It actually came from Dave Ramsey, but Dave said, hey, I was meeting with this billionaire once, someone who was very successful, was a great investor, and had done great throughout his whole career, and he had a book that he wanted to share with Dave on the secrets of investing. And it's when Dave was really young, Dave says, oh my gosh, I'm so excited to see what this book with all his secrets are. And he comes up to Dave and he hands him a copy of The Tortoise and the Hare. So why is The Tortoise and the Hare a great story of investing? Because if you read it, who always wins?
The tortoise.
The tortoise. There you go. So I always like to use that analogy and use that story to say, hey, stick to your plan in the long run and good things will happen.
Awesome. Well said. Well, and Ben, I couldn't end it any better myself, so I love it. If you have any questions about these topics or anything else, if you have a financial advisor, feel free to share this video with them, and it might be able to help you and help them help you. And if you don't, give us a call at Kentucky Planning Partners. We're actively taking on new clientele, and we'd love the opportunity to serve you and your family and have these conversations with you. And if you really don't have a financial plan, that's like being on a sailboat without a rudder. You might get somewhere, but it's probably not going to be where you want to go. So come in, sit down with us, and we'll be able to help you develop a plan, give you clarity on your future, and help you realize the life that you've earned. Our phone number is 502-394-0400, located on the heart of Louisville's east side. My name's Kyle Roy, and on behalf of Ben Hopper, my colleague, and everyone here at KPP, thank you for watching. We look forward to seeing you soon.